Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Please subscribe to the channel and also please do like and share and leave your suggestions in the comment section. Today I am going to talk about all the master circulars on bank finance to non-banking financial companies. Bank of India is offering this facility. Purpose: to lay down the Reserve Bank of India's regulatory policy regarding financing of NBFCs by banks. Classification: a statutory guideline issued under Section 35A of Banking Regulation Act 1949. Previous guidelines: Master Circular DOR CRE RDC number 07 by 21/4/172/2023-24 dated 3rd April 2023 on bank finance to non-banking financial companies (NBFCs). Application: to all scheduled commercial banks, excluding regional rural banks. Master Circular on Bank Finance to Non-Banking Financial Companies. Introduction. Introduction. Reserve Bank of India has been regulating the financial activities of the non-banking financial companies under the provisions of Chapter 3B of the Reserve Bank of India Act 1934. With the amendment of the Reserve Bank of India Act 1934 in January 1997 in terms of Section 45 IA of the said Act and amendment of the National Housing Bank Act 1987 in August 2019 in terms of Section 29A of the National Housing Bank Act 1987, all non-banking financial companies, including housing finance companies, have to be mandatorily registered with the Reserve Bank of India. Terminology: NBFCs means the non-banking financial companies registered with the Reserve Bank of India, which shall also include Housing Finance Company (HFC) registered under Section 29A of the National Housing Bank Act 1987. Current investments means that investment classified in the balance sheet of the borrower as current assets and are intended to be held for less than 1 year. Long-term investments means all types of investments other than that classified as current assets. Unsecured loans means the loans not secured by any tangible asset. Background: the credit-related matters of banks have been progressively deregulated by Reserve Bank of India, consistent with the policy of bestowing greater operational freedom to banks in the matter of credit dispensation and in the context of mandatory registration of NBFCs with the Reserve Bank. Most of the aspects relating to financing of NBFCs by banks have also been deregulated. However, in view of the sensitivity attached to financing of certain types of activities undertaken by NBFCs, restrictions on financing of such activities continue to be in force. Master Circular on Bank Finance to Non-Banking Financial Companies, Bank Finance to NBFCs registered with RBI. The ceiling on bank credit linked to net owned fund (NOF) of NBFCs has been withdrawn in respect of all NBFCs which are statutorily registered with RBI and are engaged in principal business of asset financing, loan, factoring and investment. DOR MC Bank Finance to NBFCs 2024 activities. Accordingly, banks may extend need-based working capital facilities as well as term loans to all NBFCs registered with RBI and engaged in infrastructure financing, equipment leasing, hire purchase, loan, factoring, and investment activities subject to provision of para 8 of these guidelines. In the light of the experience gained by NBFCs in financing second-hand assets, banks may also extend finance to NBFCs against second-hand assets financed by them. Banks may formulate suitable loan policy with the approval of their boards of directors within the prudential guidelines and exposure norms prescribed by the Reserve Bank of to extend various kinds of credit facilities to NBFCs subjected to the condition that the activities indicated in paragraphs 4 and 6 are not financed by them. Master Circular on Bank Finance to Non-Banking Financial Companies. Bank Finance to NBFCs not requiring registration. In terms of Master Direction, exemptions from the provisions of RBI Act 1934 dated August 25, 2016 as updated from time to time, few categories of non-banking financial companies are exempted from certain provisions of the Reserve Bank of India Act 1934, the RBI Act 1934, including the need for registration with the Reserve Bank. For such NBFCs not needing registration with the Reserve Bank, banks may take their credit decisions on the basis of usual factors like the purpose of credit, nature and quality of underlying assets, repayment capacity of borrowers, as also risk perception, etc. Master Circular on Bank Finance to Non-Banking Financial Companies. Activities not eligible for bank credit. The following activities undertaken by NBFCs are not eligible for bank credit. Bills discounted or rediscounted by NBFCs except for rediscounting of bills discounted by NBFCs arising from sale of commercial vehicles including light commercial vehicles, two-wheeler and three-wheeler vehicles subject to the following conditions. The bills should have been drawn by the manufacturer on dealers only. The bills should represent genuine sale transactions as may be ascertained from the chassis or engine number. Before rediscounting the bills, banks should satisfy themselves about the bona fides and track record of NBFCs which have been discounted the bills. Investments of NBFCs, both of current and long-term nature in any company or entity by way of shares, debentures, etc. However, stockbroking companies may be provided need-based credit against shares and debentures held by them as stock in trade. Unsecured loans or intercorporate deposits by NBFCs to or in any company. All types of loans and advances by NBFCs to their subsidiaries, group companies or entities. Finance to NBFCs for further lending to individuals, for subscribing to initial public offerings, IPOs, and for purchase of shares from secondary market. Leased and subleased assets. As banks can extend financial assistance to equipment leasing companies, they should not enter into lease agreements departmentally with such companies as well as other non-banking financial companies engaged in equipment leasing. Master Circular on Bank Finance to Non-Banking Financial Companies. Bank Finance to Factoring Companies. Notwithstanding the restrictions mentioned above, banks can extend financial assistance to support the factoring business of factoring companies, NBFC factors, and NBFC ICCs holding certificate of registration under the Factoring Regulation Act 2011. To be eligible for bank finance, following criteria must be satisfied by the factoring companies. The companies qualify as factoring companies and carry out their business under the provisions of the Factoring Regulation Act 2011 and notifications issued by the Reserve Bank in this regard from time to time. The financial assistance extended by the factoring companies is secured by hypothecation or assignment of receivables in their favor. In addition to the above, NBFC factors must also satisfy the following criteria to be eligible for bank finance. They derive at least 50% of their income from factoring activity. The receivables purchased or financed is irrespective of whether on with recourse or without recourse basis from at least 50% of their assets. The assets or income referred to in the 2 points above would not include the assets or income relating to any bill discounting facility extended by them. Master Circular on Bank Finance to Non-Banking Financial Companies. Other prohibitions on bank finance to NBFCs. Bridge loans or interim finance. Banks should not grant bridge loans of any nature or interim finance against capital or debenture issues and or in the form of loans of a bridging nature pending raising of long-term funds from the market by way of capital, deposits, etc. to all categories of non-banking financial companies. Banks should strictly follow these instructions and ensure that they are not circumvented in any manner whatsoever by purport and or intent by sanction of credit under a different nomenclature like unsecured negotiable notes, floating rate interest bonds, etc. as also short-term loans, the repayment of which is proposed and expected to be made out of funds to be or likely to be mobilized from external or other sources and not out of the surplus generated by the use of the assets. Advances against collateral security of shares to NBFCs. Shares and debentures cannot be accepted as collateral securities for secured loans granted to NBFC borrowers for any purpose. Restriction on guarantees for placement of funds with NBFCs. Banks shall comply with the instructions as provided under paragraph 2.4 of Master Circular Guarantees and Co-Acceptance dated 1st April 2024 as updated from time to time regarding restriction on issuing guarantees for placement of funds with NBFCs or other non-bank entities. Master Circular on Bank Finance to Non-Banking Financial Companies. Prudential ceilings for exposure of banks to NBFCs. The definition and method of computation of exposure would be as prescribed in the Circular on Large Exposures Framework dated 3rd June 2019 and amendments made from time to time. Banks' exposures to a single NBFC, excluding gold loan companies, will be restricted to 20% of their eligible capital base, Tier 1 capital. However, based on the risk perception, more stringent exposure limits in respect of certain categories of NBFCs may be considered by banks. Banks' exposures to a group of connected NBFCs or group of connected counterparties having NBFCs in the group will be restricted to 25% of their Tier 1 capital as detailed in Circular on Large Exposures Framework dated 3rd June 2019. Read with Circular on Large Exposures Framework dated September 12, 2019. The exposure of a bank to a single NBFC which is predominantly engaged in lending against collateral of gold jewelry. Such loans comprising 50% or more of their financial assets shall not exceed 7.5% of the bank's capital funds, Tier 1 plus Tier 2 capital. However, this exposure ceiling may go up by 5%, that is up to 12.5% of bank's capital funds if the additional exposure is on account of funds lent by such NBFCs to the infrastructure sector as detailed in circular on bank finance to NBFCs predominantly engaged in lending against gold dated 18th May 2012. Banks may also consider fixing internal limits for their aggregate exposure to all NBFCs put together. Banks should have an internal sublimit on their aggregate exposures to all NBFCs having gold loans to the extent of 50% or more of their total financial assets taken together. This sublimit should be within the internal limit were fixed by the banks for their aggregate exposure to all NBFCs put together as prescribed above. Infusion of eligible capital funds after the published balance sheet date may also be taken into account for the purpose of computing exposure ceiling. Banks should obtain an external auditor's certificate on completion of the augmentation of capital and submit the same to the Reserve Bank of India Department of Supervision before reckoning the additions to capital funds. Banks shall adhere to the intra-group limits in accordance with guidelines on management of intra-group transactions and exposures dated 11th February 2014. Master Circular on Bank Finance to Non-Banking Financial Companies. Restriction regarding investments made by banks in securities or in instruments issued by NBFCs. Banks should follow the guidelines provided under Para 30 of Chapter 9, Investment in Non-SLR Securities of Master Direction, Classification, Valuation and Operation of Investment Portfolio of Commercial Banks, Directions 2023 as updated from time to time. Master Circular on Bank Finance to Non-Banking Financial Companies, Risk Weights for Bank Credit to NBFCs. Banks' exposure to NBFCs shall be subject to capital charge as per the risk weight prescribed in paragraph 5 of Master Circular DOR CAP RDC 4 by 21.06 to 201 2024-25 dated 1st April 2024 as updated from time to time. Thank you very much for your patience.